Hey everyone, this is Deep Dive Stock Earnings. Today we're taking a closer look at PDD Holdings, the parent company behind Pinduoduo and Temu. They just released their latest quarterly earnings. And even though profit came in very strong, the stock still dropped around 5% during market trading. A lot of investors saw that reaction and were confused how can a company beat on earnings and still sell off. Why is the market not responding positively? So today, I'm going to break down the numbers, the environment, the real concerns behind this reaction, and give you a clean picture of what's actually happening with PDD. Let's start with the most important part of the earnings, revenue. PDD reported total revenue of 108 yuan, 276.5 million, which is roughly 108 yuan and 3 billion RMB for the quarter. That's about 9% year-over-year growth. Now the key thing here isn't that the number is bad, as that growth continues to slow, and the result came in slightly below market expectations, which were around 108 yuan and 4 billion. So the gap is tiny, almost negligible, but for a company like PDD, not beating the expectations is enough to trigger concerns for high-growth e-commerce platforms. The market wants to see clear, consistent outperformance. Even a slight miss tells investors that momentum is cooling. On the profit side, however, things look very strong. Net income came in at 29 yuan, 328 million, which is about 29 yuan and 3 billion RMB, up 17% year-over-year. That's a very healthy jump and shows that PDD continues to optimize its operating efficiency. They've clearly adjusted their cost structure, streamlined subsidies, and improved platform margins. When you do that effectively, the bottom line grows faster than the top line. But here's the thing. The market always views profit as something that can be influenced by strategy, efficiency, or short-term adjustments. Revenue growth, on the other hand, reflects fundamental user activity, GMV expansion, and the strength of the global business. So even though profit beat expectations, it doesn't erase concerns around the slowing revenue trajectory. The company straight up said in its report that competition is heating up, and honestly, you don't need them to tell you that you can feel it. Temu isn't just fighting a few newcomers. They're up against massive platforms with deep pockets, long-standing customer trust, and logistics systems that are almost impossible to replicate. Temu broke in fast with aggressive pricing, grabbed attention, and made a lot of noise, but keeping the momentum, that's a whole different game. So when revenue came in just a touch like this quarter, the market didn't shrug it off. It immediately read it as, okay, the crazy growth might finally be cooling a bit, and once Wall Street smells a slowdown, even a tiny one, the stock reacts instantly. And there's another layer. Management said they will continue increasing support for merchants and investing in their ecosystem, things like logistics, supply chain, merchant tools, and international infrastructure. These are positive long-term moves. But financially, it means profits may fluctuate in the coming quarters. Markets absolutely hate uncertainty. Even if a company doesn't say profits will decline, simply saying results may fluctuate is enough to make institutions step back. That's exactly the kind of message that leads to short-term selling, even when the quarter looks strong on paper. So what about growth going forward? If you check analyst forecasts from places like Yahoo Finance and Fiscal, next year's revenue growth is still projected to be around 20% to 25%. That's a very solid number. It tells us growth isn't disappearing, it's just normalizing. As PDD becomes a larger global platform, slowing from hyper-growth to high growth is a natural transition. The market isn't saying the company won't grow, it's saying the growth rate will probably be more moderate and more consistent rather than explosive. Now if we zoom out and look at PDD's overall financial health, the strength of the business is still very clear. Revenue growth has slowed, but it's still in double digits. Profit jumped significantly because of margin optimization. Free cash flow may fluctuate, and management said the clearly viewed long-term trend is still positive. Debt levels remain very low and continue falling, so the balance sheet is extremely clean, and the standout metric is ROIC. At 92%, PDD is operating with exceptionally high capital efficiency. That level of return on invested capital is something very few companies in this industry can match. It's a sign of strong execution and a powerful business model. So now let's answer the question everyone cares about. Does a 5% drop make sense? Was the stock overreacting, or is the market simply adjusting its expectations? In my view, the reaction is reasonable. The market is pricing in long-term concerns, not short-term wins. Slowing revenue growth, intensified competition, and potential profit volatility. These are all elements that influence valuation far more than a single quarter of strong EPS. Investors aren't punishing PDD. They're simply recalibrating the company from a hyper-growth multiple to a mature high-growth multiple, and that's normal. No company sustains breakout growth forever. So the real question is this a buying opportunity? For long-term investors, the current price is not dangerous, but it's also not a screaming bargain. It sits in that reasonable to slightly attractive range. It's a price you can't start with a small position, especially if you believe Temu can continue scaling internationally and hold on to its user base. But if you're thinking about a large position, you probably want to wait for the next 2 or 3 quarters to confirm whether growth stabilizes or continues slowing. Temu's global traction will be the deciding factor. In short, PDD remains a strong company, but it's entering a new phase where growth is moderating and competition is intensifying. The business fundamentals remain healthy, the balance sheet is clean, and the profitability is impressive. But the market is now treating PDD as a more mature company, not a rocket ship, and that's why the stock pulled back. So whether this is a buy really depends on your investment horizon and your conviction in Temu's global expansion. Small positions make sense. Heavy positions require more confirmation. That's my full breakdown of PDD's latest earnings. Let me know what you think in the comments on Deep Dive Stock Earnings, and I'll see you in the next one.